Hey investor friends, I'm Michelle Markey, and today I'm going to talk about some of my investing mistakes that I'm comfortable with sharing, and I hope you don't make my mistakes. And we're all on our own hero's journey towards financial freedom, or as I like to think of it, as FIRE, financial independence, retiring early. And with this idea that we're on this investing journey, there's a certain call to action that we feel like we're drawn to this idea that we can not only compound our savings, but have a future where we have all the options that we could dream of. And this leads us through a lot of travails and trials, and we make a lot of mistakes along the way until we somehow atone for these mistakes and we eventually prevail, and then hopefully end up in a good place in life and live happily ever after, like a lot of fairy tale stories go. So in order to have our own hero's journey, unfortunately, there also comes the challenge of how we get over the mistakes we made and learn from them and try not to do the mistakes again. And I'm definitely not perfect. I've made plenty of mistakes, and I'll probably continue making a lot more mistakes, especially when it comes to investments. And the important thing is I'm trying to become a better investor over time and hopefully achieve my own dream of my end result of hero's journey. So I hope you will do the same. I'm treating this as a bit of a safe zone and hope you won't judge me. And if you could please like and subscribe, I'd be super grateful. And I'd also love to hear from you in a comment, so thanks. I'll cover 10 of my investing mistakes in no particular order or priority. And the first one is I invested in a social media company stock because I was a millennial and people were saying it had great prospects and a profitable future. And yet I found myself questioning this company's sense of ethics, and I didn't really study the company too much. I mean, I knew a little bit about their management, but I hadn't put in the time to really ascertain if I believe in the future of this company. So I decided to just sell that company and not have that kind of mistake on my conscience anymore. Mistake number 2 is owning a company for less than a year, then selling it at a profit and then having short-term capital gains tax. And the reason why this makes a difference is short-term gains are based on your ordinary income tax brackets, and compare that to long-term capital gains tax, which for most people is probably 15%, but could range up to 20% if you make over $440,000 or so a year. And so if you compare that to, say, most people being in income tax brackets between 22 to 37%, paying 15 or 20% in long term is a lot better than paying anywhere from the short term if you have at minimum income tax bracket of 22% or higher. So for that reason of tax savings alone, it's a good idea to be invested in the long term, as in more than a year, so that you don't have to pay short-term capital gains tax like I've had to in the past. Mistake number 3 is maybe not completely a mistake, but it's sort of not a fun place to be either, is when we're not able to be fully invested all the time. So right now, when I think we're at some of the highest market highs in January 2021, it makes me feel like I shouldn't be too invested right now, because if the stock market crashes, a lot of my asset values could go down significantly. So I regret some of this because it means I'm sort of missing out on how there could be stock market gains if only I was invested. And the fear of missing out, or FOMO, is pretty real, but I try to stay cool about it, level-headed, and not feel like I'm not able to compound my money, although it's unfortunate if you can't compound your saved money all the time. I mean, I would really love to be compounding my money at the maximum investment rate that I'm able to achieve, but that's also not always possible. So it's something I try to think about, because I would prefer to be invested. And so what I need to do next time is buy a company when it's on sale and stay invested in that for many years, if not forever, as long as it stays a good company. Number 4, I combine committing errors of omission and errors of commission, like I talked about in my Christmas investing video. And when it comes to errors of omission, I talked about that at great length in that video. I missed out on investing in certain companies at certain points in time when I thought maybe I might want to invest in these companies. So I missed out on a lot of gains, but that means error of omission is not taking action when you know you should have, while an error of commission is taking an action and then you're wrong and you made a mistake. So I've also made errors of commission where I've bought companies that I came to regret later on. And that's just something to be mindful about, is sometimes I acted in the error of commission because I had a bit of a scarcity mindset back then, as if I don't buy this company now, it won't be this price in the future, and then it will just go up and up. And we have to remember that things don't always just go up and up in the stock market. Sometimes they do go down, and they could go down hard and fast. And if we pay attention to when we value a company and it goes on sale at a price that we're willing to buy it, then we should take the appropriate action at that point in time. Number 5, buying a company that IPO'd just recently. And IPO means initial public offering. And I was influenced to buy a company from reading a newspaper article that was talking about how great the company was. And little did I realize what kind of happens with IPOs, where a lot of people who put in money into the company to begin with, they kind of cash out when companies IPO sometimes. And sometimes the company drops immediately after it IPOs. And then maybe if we wait around a little bit for it to settle down, that might be a good time to buy it. And I made the mistake of buying it as soon as the IPO came out without really thinking about, do I really want to be invested in this company? I didn't do the necessary extended research that I should have beyond just reading a newspaper article. So it's not to say that IPO companies won't just skyrocket sometimes. It's very possible they might after their IPO price, but a lot of times they also go down. So it's worthwhile to really study a company, especially if they don't have 10 years worth of public investment information and documentation available. A lot of the financial data is not available on private companies before they go public. So something to consider if you're interested in buying an IPO company. Number 6, in my 401k one time, I bought a small cap index fund because I looked at its last 10 years of performance and it looked like it had been outperforming large cap companies in another index fund for a while. And the lesson learned here is that past performance isn't an indicator of future success necessarily. And it's not to say that small cap funds are bad or large cap funds are better. Either or could be good and bad. And this is aside from the fact that I have some misgivings about the extreme diversification of index funds. But that aside, by investing in something that I thought had a good rate of performance, a good return on investment, it doesn't always. So just because things have always gone up doesn't mean that they will continue doing so. And stuff happened at that time in the market when small cap companies got really battered at that point in time. So it's just something to consider when you're choosing certain funds or stocks for your 401k or other investment accounts. Number 7, getting faked out by the market. So at March of 2020, I thought I did a good thing by selling a company that I thought reached its intrinsic value, and I sold it before the coronavirus recession started in March of 2020, and I felt good about myself at that time. But then when the market started roaring back towards the end of March and April and into the summer, I didn't get back into the same company that was inherently a good company, and I regret that because I should have never sold the company. I thought this was the big one and I was wrong. So it's a lesson learned about kind of trying to time when we think it's time to get out of the market, but also I shouldn't have been afraid to get back into the market. Number 8, since we can never really know when we're at the bottom of a company's stock price, it's hard to kind of buy at the right, best possible time. So I have difficulty sometimes doing what's called tranching in, where I only buy some of the stock at a time. So maybe at a certain price, I'll buy 25%, then some more time goes by and maybe the price will be lower by another 25%. Maybe it goes higher one time by another quarter, and then maybe it goes back down even more, and then I could buy the last quarter of whatever full position I want to be in. but I haven't always done that. I've tended to just want to buy my whole position at one time and not be bothered about tranching in. But I realize now that I shouldn't have been worried about things like commission fee costs, and before that used to be a thing, but now we don't have as much commission fees. So I shouldn't be as hesitant to gradually tranche into a stock when I'm willing to buy it at a price that more or less is within range of the price that I'd like to buy it at, what I calculated its buying price to be, or what I calculated its margin of safety price to be. Number 9 isn't really investing, it's more trading, but when it comes to options and derivatives, which mean kind of the same thing, it's a contract between agreed upon parties involved, and it talks about the value of an asset, usually a financial asset, and it can give someone the right to buy it, or it can make someone obligated to do a certain action with the option or derivative. So Buffett has said that options are weapons of mass financial destruction sometimes. So it's important to bear in mind that it's no joke when it comes to trading options. You can seriously lose some capital, as I've done in doing some options trades. Number 10, where I think my investing process was correct, and I emulated a guru investor who is renowned and tends to invest in great companies. So I tried verifying how this one company was performing, and I did my own research, valuation calculations, and I really believe that this company was going to live up to the value that I was calculating it should perform at, because based on its free cash flow yield, it looked like it was on the up and up. And I thought that, well, I guess with this guru investor that I was following at the time, I thought that this would be tails, I don't lose much, and heads, I win. So kind of thought that this was going to work out, but unfortunately, it looked like maybe it became a bit of a value trap where you think something is good value, but then really you kind of just get stuck in the mud and the company doesn't really go anywhere. And to make matters worse, it decided to merge with another company, which I think tends to be value destroying based on my investing research. And I'd rather the company have spun out some of its divisions that were really cash flow generating, and I'd probably invest in that company if it ever did it. But it's just unfortunate that this company is maybe going to lose some of its value by merging with another company, and they're doing it because of purported synergies from cost-saving measures that they can do by combining powers into one company. And that's nice and all, but as an investor, I kind of don't like how it's changing that way, and it's not really what I want to be invested in now at this time. Whew, that was a bit cathartic, talking about 10 of my mistakes that I can think of. These are probably the top of them. So they're the best mistakes I could think of that I hope will be helpful to you as you're also learning and on your own hero's journey towards financial freedom. And if you enjoyed this video or learned something, please like and subscribe. And I look forward to talking with you more about my investing insights that I learned from various sources. So till next time,